Very well, thank you.
So hello, everyone. Thank you for coming to the session. Since you're not new to the financial series, I will pass it straight to Anthea, and she can begin her presentation.
Great. Well, thank you very much, Anthony. I am delighted to be back. We are here at our third session in the series of personal finance education, known as the Savings Challenge of February 2021. And we call it a savings challenge because we're encouraging all of our attendees to not just learn from these presentations, but also to think more concretely about how to save money, how to use the information that you're learning to improve your long-term prospects for financial wealth gathering and financial stability, something that I talk about all the time, both in presentations and also with individual clients. So you'll see that for each week, we've had a little challenge. They're not intended to be big reports, big time-consuming challenges, but a little exercise that will help you embrace what we're trying to impart. So we've talked about budgeting and saving. Last week, we talked about income taxes and tax planning. And I've gotten great questions for all of these presentations, so I know that you are engaged and thinking about it and how it relates. Today, we're going to talk to credit and student loan debt management. Very interesting and important topics for people who are presently in graduate school. Many of you, I'm sure, had to take out loans for undergraduate, so you are potentially looking out at some significant student loan debt that you will have to manage once your education is done. So we're going to talk through that, give you a lot of resources, things to look at your leisure, and also to think about while you're in school and preparing for the next phase in your career. Next week is our final presentation. We're going to talk about managing your finances during an emergency. This comes, of course, after the experience we all went through with the pandemic. You've been in school, but I'm sure around you, you've watched people whose jobs have been dramatically impacted by the pandemic. A lot of people were unemployed. And so it is a collection of tips, what to do when you go through an emergency. And this can be, it applies as well for a personal emergency. It doesn't have to be a pandemic. So for all of the challenges, you email Anita or Anthony with your entries. And again, they're intended to be simple, little essay type things. And you're competing for prizes. And I have the prizes and wanted to show them to you. So the book, How I Invest My Money, and the Wall Street Journal guides on personal financial, or actually Guide to Understanding Personal Finance and Guide to Understanding Money and Investing. So I encourage you to participate. Should be fun. So today, as I mentioned, we're talking about dealing with debt, student loans, and credit cards. Federal student loans offer a lot of benefits, as many of you have probably come to realize. If you remember back as an undergraduate going through the whole FAFSA application fire drill when you were first accepted to a school, and you may have remembered from those early financial aid awards that what you were offered to attend your undergraduate school typically included some grants and some loans. This is pretty standard stuff. And depending on your income, or really your parents' income when you applied, you were either eligible for subsidized loans or unsubsidized loans. Anybody can get a non-income based unsubsidized loan. And once upon a time, there was a big difference between the two. The subsidized loans had lower interest rates than the unsubsidized loans. Now that's not the case. They have the same interest rates, but what does make them very different is that a subsidized loan does not accrue interest while you're in school. Whereas an unsubsidized loan, as soon as you take it out, the interest meter starts to click. The other wonderful benefit of student loans is that it's not credit score dependent. So provided you apply, you should be able to get a federal student loan. And they offer some very helpful benefits, including deferment So if you may have done this going into graduate school, decided to defer repayment on any undergraduate loans you took out. And again, if they're unsubsidized, interest is clicking along, but if they were subsidized, that interest is not yet growing. The other benefit, you can apply for what's called forbearance. If, for example, you are actually working and maybe you have to go out on medical leave and you can't afford to keep up the payments, whatever it is, if you have some form of hardship, you can take a forbearance for a pretty generous length of time. During forbearance, your interest accrues, regardless of the type of loans you have. So it's an escape valve for making payments, but you have to be thoughtful when you ask for forbearance. The other great thing about federal student loans is that they are, in most cases, eligible for public service loan forgiveness, which is a unique program. If you've read about it in the papers, there are a lot of complaints about it. Loans have only been in the forgiven phase since 2017, and there's been a lot of effort to improve people's chances of having their debt completely forgiven through this program, since some of the early applicants really struggled. So I'm going to talk at length with this program because there may be many of you who are eligible for it, and it may be a good thing to pursue. So I want you to know about it. It's important to have a sense of your federal loan debt, and you can look up all of your loans online at the National Student Loan Directory, and that's the website, NLSDS. It lists every loan you took out and the features of the loan, the interest rate, the current servicer, because although the Department of Education is responsible for issuing the loans through your college typically, the servicing and collection of repayments is actually done by one of 8 different servicing agencies. And these are all the names you hear your friends complaining about: Navient, Mohiga, Mohila rather, etc. Having an idea of what the status is of your loans by going online and knowing when your repayment obligation begins is very, very important to avoid late fees and extra charges. You don't want to inadvertently end up in default simply because you've stopped paying attention, you don't use the email that they have for you, maybe you've moved as you've gone from undergraduate to graduate school. So it's on you to understand where you are with each of these loans. If you visit the Department of Education website, studentaid.ed.gov, they have listed all of the repayment plan information. They do have repayment plan advice. One of my challenges with this site is that it aspires to do a lot of stuff. It helps students get ready to apply using FAFSA, and it helps students who are currently borrowing, and it helps people who are looking to set up repayment. So it is an electronic forest. And as a government website, it has its challenges. It's not organized in an intuitive manner. So sometimes it's very hard to find exactly what you're looking for without rummaging around a lot in the various drop downs and web pages. Before you begin to turn on your repayments or elect a repayment plan, it is very important, going back to our first session, to put together a monthly budget. How will you know if you can afford a standard repayment plan if you don't know what your income and other expenses add up to in a given month? So you want to be very thoughtful, because it's kind of a pain to change your repayment plan once you get started. The standard or default repayment program is 10 years. So if you have significant loans from undergraduate and graduate school, you want to get out in front of this because there are other options available to you. If you have graduate student debt, you can elect 15 years. And if your cumulative debt is over $30,000, you can actually elect a 25-year repayment plan. Now, that may not make sense, and I'm going to show you a repayment calculator, how to get to it, because the longer you pay a loan, the longer you're paying interest. So it may not be in your best interest to elect a super, super long repayment period. Federal student loans do offer income-based repayment plans and income contingent repayment plans. And the IBRs there's a formula that count 10% of your discretionary income as available for loan repayment. When you play with their calculator, the student loan repayment calculator, and you indicate you want to apply potentially or check out what an IBR program would give you as a monthly payment, you will begin to understand how they come up with 10% of any person's discretionary income. Part of it relates to whether you're single or married, whether you have dependents, whether you live in New York or other expensive or less expensive states. All of this is factored in to give you what your monthly payment would be. A better place to go, as much as the Department of Education is comprehensive and it is the absolute answer for all things related to federal student loans, I like referring people to this website, ibrinfo.org, and I have a screenshot of it further into the presentation. This is a nonprofit that is dedicated to providing guidance and information about income-based repayment plans because too many people don't know about them and fall into default because they can't keep up with their loan payments and run into all sorts of trouble. What's great about it is that it hyperlinks to the studentaid.ed.gov website. So if you click on the student loan payment calculator, it takes you exactly where you need to be on the federal government's website. You don't have to search for it. You don't have to do a million clicks. This goes right there. There are other ways and other places in the IBR info that also click through that are super helpful for just making finding things a little bit easier on the government site. But one of the best things about this website is the comprehensive information they have on the Public Service Loan Forgiveness Program. And we're going to look at that in more detail. Oops, forgive me. If you end up or know friends who've ended up in default, and that can happen through becoming unemployed, having gaps between a job and going to school, or being slow to set your payments, begin your repayments, student loans can be rehabilitated and put back into active status in two ways. If you call up and ask to have, set me up for the rehabilitation program, you'll get an income-based repayment plan. And once you are in it for 9 months, you're fully back in good standing and eligible for every available benefit, whether you need deferral, forbearance, or the Public Service Loan Forgiveness Program. For people in that situation, you request a reasonable and affordable payment plan. That's sort of the key that kind of opens up this whole conversation about rehabilitation. And there's a lot of information on that website that I know and recommend all the time. The Department of Education has contracts with these 8 servicing organizations that do all of the guidance on selecting repayment plans and servicing the actual loan payments as they come in. So whether you have had a student loan with a fixed or a variable interest rate, and variable interest rates are more typical for grad plus loans than for undergraduate loans. This, just expect that information will be there when you start looking at the National Student Loan Directory to identify all of your individual loans. There's a lot of information on consolidation, loan consolidation, and I get a lot of questions about, is that a good idea or not? A lot of people are surprised that by the time they've borrowed money through FAFSA for undergraduate degrees and graduate degrees, they have just a long list of loans and sometimes multiple different servicing agencies to which they're going to have to make payments. And they say, well, why don't I just consolidate the whole thing and just have one payment? Well, the first thing to think about is that consolidation will give you a weighted average So the interest rates may be different on every loan you've taken out. If your biggest loan is your most expensive loan, you could end up with a higher interest rate against all the money you borrowed. So you have to think carefully before you elect to do that, because once you consolidate, you can't unconsolidate. It's a one-way obligation. You get a new promissory note, the whole thing. There are pros and cons, great essays on studentloan.hero. I have a screenshot of that really helpful website as well at the back of this presentation, and we can look at that in greater detail. They do a lot of really good explanatory essays and articles on things like whether to consolidate, whether to refinance, or whether to pay off aggressively. And they have wonderful calculators on their website to help you make those informed decisions. When you actually do the consolidation, which does make sense in some instances, you can do that directly on the studentaid.ed.gov website. It's very easy. I've sat with people and guided them through it. And it's literally a series of buttons you click to make sure that this happens as you intend. And you don't have to consolidate all of them. It's also a choice just to consolidate a few. Now let's talk a minute about the Public Service Loan Forgiveness Program, because this may be of interest to anyone. You're all in graduate school. Some of you will stay in research, and you may work for an entity like Mount Sinai that is a 501c3 organization, meaning it's not for profit. People can make tax-deductible charitable contributions to support the mission. Employees who work for not-for-profit organizations or the government and religious organizations, so long as they are not preachers and proselytizing, are eligible for the Public Service Loan Forgiveness Program. It was designed and intended for people in these types of jobs, work for these types of organizations who are not highly compensated, to be able to make payments for 10 years under an income-based repayment program. So it's a modest to low repayment, monthly repayment amount. And after making 120 on-time payments, fill out a forgiveness form at the very end, and your balance, whatever's left that you haven't paid off, is forgiven tax-free. This is the only forgiveness program where it is tax-free. There are other programs that for teachers and for other different types of professions where they'll set up a forgiveness program. That's not tax-free. So after the loans are forgiven, you have a tax bill on the money that has been forgiven for you. So what happens, though, is important, and you have to understand the steps and the way they sort of interact in order not to kind of get blown out of the process of applying. The very first thing you have to do is literally fill out a form that is signed by your HR or payroll department that certifies that your employer qualifies, that it is in fact a 501c3 organization, not-for-profit or government entity. As you do that, because you fill out your part, they certify that you work there, that you're working full-time. That is an obligation. It's not for people who work part-time. And they mail that in. You, meanwhile, have to go back to the National Student Loan Directory and check the types of loans that you have. The vast majority of loans are eligible for the Public Service Loan Forgiveness Program. But if you have some really old loans, or if you have taken out some, there's a list that don't apply, you have to know that ahead of time and consolidate those loans that aren't eligible. And all that does is render them eligible. So nothing changes. You sign a new promissory note. So, if you have one $10,000 loan, it's ineligible for public service loan forgiveness program. You go online, studentaid.ed, you consolidate that loan, and boom, it's now eligible. If your employer is accepted and your loans are all eligible, you get an acceptance letter into the Public Service Loan Forgiveness Program. They will email this letter. It is impossible to understand. It sounds like it's good news, but it's so complicated in the way it's written that you kind of have to search through it to realize, okay, I'm in the program, but you're not done. You have to make sure that your loans transfer to Fed Loan Servicing. There's only one servicing agency that handles the Public Service Loan Forgiveness Program. So if you don't ensure that they are all moved there, you think you're in the program, you're making payments thinking that they're being counted, but you're not in the program. The other place where people sort of get blown out of the program and don't realize it is that you are obligated to be in one of their eligible income-based repayment options. So if you just get accepted through the form and your loans, you get the yes letter, but you don't make sure you're at Fed Loan Servicing and you never make sure that you're an income-based repayment plan, you're not in the program and your payments are not being counted. So you have to do those three things. The best way to do this is to enter online. Use the federal loan website rather than talking to an agent, because you can get misinformation and end up with just a mess. I've seen this happen. And if you do it yourself online, it's pretty straightforward. So again, after you make 120 on-time payments, the other thing you have to do, they will send you a form to certify your income. Yes, you are in the income-based repayment plan, and most people earlier in their careers have lower income, so it's easy to stay in that. As your compensation goes up over time, you have to certify your income each time. Your payments will go up accordingly, but you absolutely have to do that recertification every year, or you will be suspended and you'll have a block of payments that won't be counted. Strategies for navigating this: enter as early in your career as possible so that you are in your low paying full-time income years. So if you are going to medical school, you're being paid as a resident, or when you are paid as a resident, you don't make $1 million as a resident, make sure as early in that job as possible that you get into the Public Service Loan Forgiveness Program. Again, because it's income-based, the monthly payments will be very, very modest. You stand a good chance, particularly if you specialize, going into a highly compensated job, and your payments are going to ratchet dramatically once that is the case. So as your payments go up, you are paying more against your loan, you will have less forgiven. So other strategies for keeping your contributions low is to use any available 403B plan. So that's a retirement savings plan, IRA contributions, to keep your adjusted gross income low, and so that your income-based repayment plan monthly payments stay low for as many of those 10 years as possible. Avoid going into forbearance, which is the hardship loan payment suspension and deferment. This is tempting if you come out and you're on a break, you're not working. If you've got tiny little loans, they don't need to know you're unemployed. Keep making them, because you don't want the payment clock to stop, since you want to just chip away at that 120 obligation. The other important thing to do once you're in the program is to check your credited payments regularly on Fed Loan Servicing. So now you don't necessarily look at the student loan or student aid.ed, go directly into your servicing agent's website, and it's typically a little button called details. When you click on details, it will give you the actual count that they've credited you toward the public service 120. I recommend that people do this regularly, because I've had so many clients where all of a sudden they notice they're missing months of payments, and you have to then contact them, call them, and get them to do this big investigation. They have to research it, and sometimes that research takes months. I had one client, a doctor, who was in residency, and he graduated. He had a nice job, started at a modest salary, was going up and up and up. And he called at my urging when he discovered that he was missing about 16 payments, and he was 2.5 years away from being out of the program and having a rather large balance forgiven tax-free. It took them a year to resolve that and to give him credit for those extra 16 payments. So important to stay on it early so that you don't run into any of those hairy situations. Other tips, I mentioned this early, but use the federal website to actually enter public service forgiveness, because you can go on there, look at your different loans, ask for the income-based repayment program, click the button to say you want to be considered for the public service loan forgiveness program, and transfer your loans to Fed loan servicing all in one sitting. Then all you have to do is make sure you get that certification form signed at your job, and you should get the good news without any hiccups. Just make sure again that all of the loans you have are the right type so that you don't have to go back and reapply because they kicked you out for having an ineligible loan. All right. Do know that right now, under the CARES Act, that the public service loan forgiveness participants are being credited for payments they don't have to make. So right now, nobody has to make federal student loan payments. This is true through April. I've heard word that that may be extended to June, who knows if longer. So that's a great thing. It is a particular benefit for public service student loan people because they don't have to make the payments, but they're getting credited anyway. And I have a couple, their clients in Brooklyn, where this has been life-changing. The opportunity to not pay this loan has allowed them to save a lot of money, which has been a really great benefit. I want to speak for a moment about private student loans. Many people take these out, and there's nothing wrong with that, but we have to be mindful that there is an obligation to repay them, and they often do not have quite as many benefits as federal student loans. Generally, when you apply for a private student loan, it's credit score dependent, and that's why most of them have parental co-signers. The downside of co-signing is that even though you are the one likely to make the repayments, it shows as a debt obligation on their credit reports. So if they are, and speaking of your parents or relatives who may have co-signed on any loans, if they want to refinance their mortgage, this extra loan or loans is considered in their debt to income ratio, and they may not be able to refinance if you have some sizable loans. Private loans offer a variety of terms and lengths. They can have fixed rates, variable rates, and a variety of repayment periods. Got to keep tab on each loan by lending organization. This is a disadvantage. A lot of people, I have literally met people doing counseling sessions at the public library who have no idea where they borrowed this money from and don't know how to get back in good standing and resolve this. They generally don't offer features like forbearance, certainly not forgiveness. They do now have some programs where if you lose your job, you can suspend payments for a few months, which is helpful. It's not quite as generous as the programs through the Department of Education. They can be aggressive in pushing loan consolidation. And there is a lot of scam activity around here, trying to get people to consolidate, and you end up with a nastier loan that you didn't intend. Refinancing. You've probably seen the ads for this because they are everywhere on social media, now on TV. Entities like SoFi, College Avenue, a huge number of private and not-for-profit entities that want to refinance student loans. It's a huge business right now. The benefits can be, for many people, lower APR, meaning a lower interest rate, lower payments, or a faster payoff. So for some people, and I've guided people both ways, stay in the federal loan program because you're eligible for public service loan forgiveness, or it's time for you to refinance these because you could get lower interest payments and you'd be refinancing a lower balance and you could pay it off faster. They do offer repayment periods up to 20 years. This can be a way to get a cosigner, like your parent or aunt, uncle, or grandmother, off your original loan so that they can have this off their credit reports. And they do offer incentives for automating your payment in the form of rate reductions. Okay. Great place to learn about it is studentloanhero.com. It is both an educational site, but also a product marketing site. And every company that's in the business of issuing student loans or refinancing student loans advertises on Student Loan Hero. And they will give their range of interest rates. I have a screenshot for you to show you. It's a great place to really explore this as a possibility. They have really good advice on how to stay on top of your loan repayments, what to do if you fall behind, what to do if your loan balances or payments are not affordable. And they have some great stories about interesting ways that people have accelerated the repayment of their loans. Other places, it's great to see who's advertising on Student Loan Hero. They do have little like reviews for the companies, but it's also good to check out these other resources, Magnify Money and NerdWallet, to get other people's opinions and ratings of those companies. Because you don't want to end up, finally getting away from Mohila, which I've heard is a nightmare to deal with, and end up with a new company. You're thrilled that you've got a lower rate and a lower payment, but then you have these other operational problems and you've traded one headache for another. This is the loan page from Student Loan Hero. So as I said, you can see all the different entities. This is not all of them. There were more, but these were the ones at the top, meaning that they had some of the best ratings from users and lowest interest rates. You can visit the lenders, and typically what happens is they'll tell you if your next click is going to trigger a credit report check. So they will generally give you an opportunity to see what your rate might be with sort of a soft inquiry where they get a sense of where your credit score is. But it's a good place to look and shop and get smart. So it's a very, very good website. Here's some other information. Here's the founder who got into this after getting $107,000 into debt on his student loans. And it only became $107,000 because he freaked when he graduated from college and took off for a year or two and did nothing about them. So he had a lot of fines and fees that were added to his balance because they went into default. He blogged about his efforts to pay down his student loans. People chimed in with their stories, and a website and business was born. So great information. If you're considering how you're going to repay loans, or if you're thinking about borrowing more, it's good to know and have access to this type of information before you do that. Now I'd like to turn to credit card debt because it often goes hand in glove with student loan debt. I see this over and over again. And largely it's because when you come out of school, you don't have the highest income, but you do have these loan payments and you've got budget gaps to fill. You got to buy food, you got to keep the lights on, all of this. So you end up with a growing balance, which at first is perfectly reasonable. And then you get to the point, this happens over and over again, where you're struggling to pay the minimums because as your balance grows, your minimum obligation continues to go up. The interest rates contribute to this. And as young people, typically you have higher interest rates than older people who have, on average, higher credit scores. So you end up in this minimum payment purgatory where you can't make any progress paying down this debt and staying on top of your student loans. How does this typically happen? Well, we generally see that people don't understand how interest works on their credit cards, that it does compound once you have the interest due become part of your balance. That's also being charged interest. So your minimum payments keep you barely above water off into the future. Usually people who find themselves treading water in this regard do not keep a monthly budget. They're not planning their spends. They're just trying to keep things going. They often have insufficient savings. There's no rainy day fund, no emergency fund that they can kind of get themselves out of this situation, or they're victims of bad luck. This happens. Somebody gets sick. I've had clients where this has happened. They have to fly and deal with this situation, and they now have these expenses on a credit card at a high interest rate and are struggling to just get rid of this. And lastly, of course, being a victim of identity theft, which is his own separate headache. So how do we do this? There are some methods for getting out of credit card debt, and I'm going to give you the steps involved. Make it very straightforward so that it's easy to do. The first thing we all have to do if we aspire to get out of debt, get our balances back to zero, is to stop using the cards, which sounds obvious, but you would be surprised at what an ingrained habit this is, particularly with the embedded cards. I mentioned this, I think, during our first session. The fact that you put your credit card information on Amazon, on Uber Eats, on all of these other wonderful handy devices means that it's really hard to stop using them when you really need to. So you got to unclick and remove your credit cards to get rid of that temptation. For the period of time, you probably need to go all cash or debit card to stop the problem from building. The next thing you're going to do is to write down all the information about your debts, because typically what I see is it's not one credit card. That's kind of easy to keep in your mind and stay on top of. But it's generally 3 to 5. I've seen as many as 12 different credit cards, all with little balances. Now, that's just being distracted and not having any process if you have that many credit cards carrying balances. But typically, I see it's about 5, 6 cards, and the balances vary all over the place. So you got to write down from each statement, current statement, the balance, the interest rate, the minimum payment due. You're going to focus on paying off one card at a time. The number one mistake I see people making is that they get a little windfall, maybe a tax refund, some overtime pay, or some gift or surprise, and they spread this money across multiple cards, and it really doesn't do anything. And then they get discouraged and they go back to just paying the minimums or making more spends using the card. So we're going to avoid that by just focusing on one at a time. After you write it all down, you're going to reorder your list. So you've got each creditor, so each credit card account, your balance, the interest rate, and the minimum payment. Now you're going to reorder it and put at the top the card with the highest interest rate. I'm going to show you an example. So here's an example of somebody who is $6,000 in debt. And right now, I looked this up recently, the average American who has credit card debt is in more than 7,000. I think it's between 7,800 is the typical balance for people who are carrying balances. It's the average. That's gone down as people have been trying to get rid of this, but it is what it is. So here's a person with $6,000 in debt. They have done a budget and they know that they have $650 that they can spend each month on paying down their credit card balances. So what they have done here is paid the minimum on every card. So if you look from the bottom of the right-hand column going up, you will see that they've paid $51 to the credit union. That's a cheap debt. It's only 9.7% interest. $10 to Barnes & Noble, $35 to Visa, $55 to Amex Blue, $20 to Home Depot, $15 to Macy's. The rest of the money remaining from that $650 is paid to MasterCard. because you are choking at a 29.95% interest rate. So if you pay $464 against a debt balance of $1,500, that balance will be gone between 3 and 4 months. Now, this is what's called the Avalanche method of paying down debt. And it's a great and effective way. In fact, it's the recommended way for most financial planners, because you you attack the most expensive debt first, and you minimize over time the total amount of interest you're going to be paying for, because it's most efficient, starting with the top and working your way down. However, one of the hardest things about getting yourself out of debt in this fashion is maintaining motivation, because this looks hard. And let's just accept that by month 2, when you're making that payment against MasterCard, it does feel like this is going to take forever. The months are clicking by, you're in all of these debts. So what I like to recommend to people is start with the snowball method and then revert to the avalanche method. And what the snowball method says, attack your smallest balances first and eliminate them, because getting rid of a debt gives you a real charge. It keeps you motivated, it gives you an early success, and you keep at it. What often happens, and I see this in real life working with clients, is that the most expensive card, it's not $1,500, it's like $7,500. Like most of the debt is on the most expensive card. So you are going to be paying that month after month after month, and it's so easy to feel defeated. So knock off the Barnes & Noble, knock off the Macy's, then attack using the avalanche method, starting with MasterCard, and you'll whip through it, and it will feel like, you've got superpowers moving through this whole process. So to begin either method, you need a budget, because you absolutely need to know how much money do you have that you could be used for debt repayment. And you really have to think long and hard if you are committed to this financial goal. It is hard to give up credit cards. It is hard to give up the lifestyle spending that sometimes ends up on cards because you're just not making enough money. So you really have to think hard if you can do it by yourself. If you can't, there are some other strategies, and I'm going to talk about each of them, give you some detail, but not get overly into the weeds. The number one that you want to look at if you're in this situation where you're starting to look at minimums and realize this is going to take me forever to get out of this debt, and I'm going to pay a lot in interest, things that you can consider. If you have a job, meaning you have income, you have savings, you can pursue debt consolidation. So the 2 forms of debt consolidation are going to your local credit union and taking out a debt consolidation or personal loan and using that money, which right now is typically interest rates are 6.75 to 7.75, much cheaper than 29.95. So you take out a loan, you use that money to pay off the credit card. Now, you don't close the credit card, you leave it at a 0 balance. Remember from our conversations earlier that that's important. It adds to your credit score. So that's helpful if you can borrow in that fashion and reduce the cost of money. So that's what this exercise is. Where can we more cheaply pay down this debt? We don't want to pay it off to the credit card because that's at 29.95. I'll take out this loan at 7.75, and this will make that go away. So yes, you have saved some money. The other way you can do a debt consolidation is taking advantage of the 0% interest balance transfer cards. These can be really, really good. Now, the better ones require a really good credit score. Just know that up front. So when you notice this happening to you, that you've got balances at high interest rates going up, move early while you're still in financial control and your credit score is high. And the way this works is you call up and they ask you some questions, they check your credit report, and you give them permission to, and they'll tell you how much they would let you transfer. Now, it's not 100% free. They charge a transfer fee, typically 2.75% of the balance transferred, and that gets added to the balance. So this can be still a great deal because if you transferred, say, $10,000, 3% of that is $300. So that's a great cost. And for some cards, they give you 12 months and the better ones 18 months to pay it off at no interest. So then what you have to commit to do if you make this transfer is to divide the balance by either 12 or 18 months. That's your monthly payment, and absolutely pay it off while you have 0% interest growing on it. You'll get yourself out of debt and you will save yourself the pain of when that goes back to interest at the end of the transfer term. So those are great. Those are two good ways to get out of debt using a consolidation type of product. Another thing that you can pursue is what's called a hardship plan. So if you've run into some difficulties, any of us can call up Visa, MasterCard, American Express. You can call up, you don't even need a hardship plan, but you can call up and ask them to waive a fee. Like if you manage to pay your bill late, doesn't happen often, you've been a great client for a long time, they will waive it if you don't ask too often. You can ask for your interest rate to be lower. They may do this because they want to hold on to you as a customer. If you've been a good customer, it's more expensive for them to get a new customer than to make a good customer happy. So you can ask for that. That's not a hardship plan. That's a customer service call. But if you're in a tough spot and you're having trouble keeping up with minimums, or you've had something happen, a medical problem, car's been totaled, whatever it is, you're now kind of stuck and the bills are bigger than you can pay. You can ask for a formal hardship plan. It will be, if they approve it, maybe 3 months to kind of get your feet back under you. While you're in that payment plan, where they will eliminate late fees, lower your interest, just take a minimum payment, maybe a lower minimum payment. They typically won't let you use the card, but once you complete the hardship plan, they'll turn it back on. So it can be as short as 3 years. It can be 6 months. It can be a year. The longer you ask for, the harder it's going to be. They may elect to simply close the card and put you on this plan to repay your balance. So, but it is an option for you that could get you out of a tight spot. The other debt option that you hear a lot about, if you listen to like news radio, you hear all these companies, debt settlement companies claiming, got trouble with the IRS, settle your debt for pennies on the dollar. Debt and credit card bills getting too high, settle your debt for pennies on the dollar. This is a business. They are regulated in a way similar to collection agencies, which means that there are some great players who follow the rules and don't harass people. And there are some shadier companies that really skate pretty close to the line. And one of the challenges is you don't know necessarily as you go into one of these outfits and talk about a debt settlement plan. What the process is you sign a contract that says you're going to make a monthly payment, and they'll tell you how much based on how much you owe. That money, after they take their fee out of it, is going to be put into basically what's like a trust or escrow account in your name. When that balance gets high enough, they start negotiating with your various creditors to try to settle for a whole lot less than you owe. There are two problems with this for the client. They don't necessarily tell these creditors of yours that they're working with you and looking to settle in the months that you're paying and building up this little war chest for them. So you are somebody who's not paying their bills, and your credit report starts to accumulate missing payments. So your credit report is getting uglier, and as a consequence, your credit score is going to go down. You could end up with defaulted debt, meaning that it hasn't been paid in 180 days before it's settled. So that's one nasty potential outcome for people using these services. The other is if you are, if they settle this debt and the debt was worth more than $600, you're going to get a 1099 and have to pay taxes on the debt that was forgiven. Now, bear in mind, the other business that these debt settlement companies are typically in are credit repair. So they help mash your credit score and dirty up your credit report. Then they turn around and they set you up with an expensive credit card and a credit building loan to fix the problem that they kind of created. So I tell everybody, avoid debt settlement companies, because there's another option that will help you get out of this bad situation, and it's called a debt management program. And here you work with an accredited nonprofit where debt counselors, trained and regulated debt counselors, help you put together a budget, help you contact your creditors. They can help with more types of credit or debt problems that you may have, not just credit cards, but if you're having trouble keeping up with a mortgage, they can get you into HUD and get that sorted out. If you're having trouble with student loans, federal or private, they can help sort that out. The debt settlement companies don't touch that stuff typically. So the debt management program, in a similar way, you put money, you send them an agreed upon amount every month that goes into an account, and they manage it and start paying down these debts. But what they negotiate with you, so the three of you are on the phone, you, Visa, and your counselor, they get you a lower interest rate. They get fees waived, so you get out of debt faster. So it can be very, very helpful if you've really, experienced a financial calamity, to work with one of these counselors to clean everything up. The fact that you work with a credit counselor will be reflected on your credit report, but you don't go into default. You don't have the same kind of damage to your credit reports. You come out of this process having paid less in interest and having a pretty good looking credit report. So it is much better. New York City's Department of Consumer Affairs actually has debt counselors that they have city contracts with that do this. The counseling is free. The debt management programs are regulated by the banking superintendent, so it's a fixed fee. Last I look, it's $50 a month. So it's none of this percentage stuff that you deal with the debt settlement companies. So it's a good option to look at. This is a picture of a place, of a website I know and love, bankrate.com. This is one of the better places to shop for a credit card. And again, you can look here. Here they have credit cards, whether you're looking for a 0% interest balance transfer card, or you're looking for a great rewards card of some kind, no annual fee card, cards that are great for traveling internationally because they don't charge fees, the exchange fees. Whatever type of card you're looking for, you can pretty much shop for it here. And the benefit of looking here is that when you click on this, you indicate which type of card you want. The information for every card issuer is exactly the same order, same details, so you can make apples to apples comparisons. This is a marketplace, so expect that if you click that you're interested in something, they will contact you. So just be forewarned, and that's true if you're looking at mortgages. Great place to look at mortgage refinance rates, information on home purchases, home equity loans, car insurance, personal loans, etc. They have very good editorial content. So, for example, I've shared with clients information about the differences, for example, between a home equity line of credit and a home equity loan. And it's great to have it in sort of clear, concise language in a place where you can also look at rates and figure out if you're ready to apply. So it's a very good website to bookmark and check periodically. All right. Just about 7 on the dot, we have concluded the content of the presentation, and we have our third and final challenge. Again, this is easy. This is not a term paper, but I would encourage everybody who has got outstanding student loans to look at them online, check the balances, make sure you recognize everything. There are instances of student loan fraud. I have worked with people who've had this happen. Somebody steals your social security number. It's not that hard to navigate their way into stealing in this form, taking out a loan in your name. So looking at your balances, interest rates, et cetera, and think about your likely career path and future employers. Are you a candidate for the Public Service Loan Forgiveness Program? Or are you more interested in paying your loans off as quickly as possible? Quick summary, just a paragraph of the steps you would take to deal with your student loans, and send it to Anthony or to Anita. Secondly, how many credits do you have and how do you use them? Think about that. Do you have one or more cards on which you're carrying a balance? The exercise here is to look at page 1 of your bill. Since the financial crisis, remember the great financial crisis in 2008 and 2010, Congress passed a law that credit card companies have to include on the first pages of our bill your minimum payment, but also how much you would have to pay if you wanted to pay your current balance off in 3 years, and how much you would save in interest if you did that. So it's basically figure out or look, research how much would you save if you paid off your balance in 3 years, and send Anita or Anthony a quick note on what you would do with the money, what you would save, that interest money that you're not paying. This is kind of a fun one. Send a paragraph on what you do with that money by not paying interest charges on your credit card balances. So now I'd like to address any questions anybody has before we wrap up, whether on this particular presentation or on any of the 2 prior. Okay, great.
Nobody has one. I have a question.
All-
So I was interested in when you were talking about the programs to pay off debt, that they kind of not pay your bills on purpose, but it destroys your credit history in
Yes.
the process while they try to negotiate the money that you paid them, which is kind of like building up on their end, but destroying
Yes.
your credit record on the your credit score on the other side. Wouldn't it make more sense to pay for like what you call it, bankruptcy, when it costs less and have less harm?
One of the things, if you're a person who is considering bankruptcy, there's actually a counseling process that has to happen first. You can't just put up your hand and say, I want to go through bankruptcy and just discharge all my debts. You have to be accepted, and not everybody is eligible depending on what the debts are and whether you have a job or not. So if you go to one of those nonprofits that does the debt counseling, and these are entities like Green Path Financial is one of the nonprofits. When you speak to the licensed credit counselors, they can kind of interview you and figure out if you are a likely candidate and set you up to do the counseling sessions that you need to take before you enter bankruptcy court. Mm-hmm.
Thank you.
Sure.
We have a question in the chat.
Yes. Okay. Secured bank credit cards are a good way to repair credit. Do you recommend any particular banks, or is that more a matter of personal preference? My big recommendation is to make sure you don't pay an annual fee for that credit card. So if your current bank will give you one at no annual fee, that's great. If they won't, you can look on bankrate.com. They certainly have secured credit cards on their website. The key thing to know, anybody walking around can get a secured credit card because you put money on account that becomes effectively your credit limit. You can't touch it, lives in a little escrow account for you, earning, tiny little bit of interest. And you go out and use your card and pay it from another source of income. As you do this over time, typically in 4 to 5 months, your responsible use of this credit card, using less than 50% of your available balance. So say you have $200 on account and a $200 credit limit. You want to use much less than $100, pay it in full on time. Because they'll give these cards to anyone, including people coming out of bankruptcy. This is one of the number one ways that they start to rebuild their credit profile, or using secured credit cards. The interest rates are incredibly high. So what you never want to do is incur either a late fee or the higher interest rate. So make sure that you pay it in full each month and then graduate to a real card. Somebody asked if the first session is going to be available as a recording, and I believe the answer is yes. And Anthony, I'll let you respond. Oh, there it is. Okay.
Yes, I believe that we recorded the first session.
Yep.
Just shoot me an email. I posted my email on the chat box, and I will send you a link to view the first session.
Have I heard of outstanding issues with people using the Rush card? I am not familiar with the Rush card, so I don't know how that one works.
So the Rush card was a card that was created by Russell Simmons, and it's supposed to teach you how to manage your own money if you don't have credit cards or a bank account.
Okay.
But the stigma that came after that was it was good promotion, but everything you did had a fee to.
Yeah. Okay.
So that was the criticism. Everything I do comes with a fee. So I wound up not having access to the full money anyway.
Yes. That I am very much against fees. So since there are no fee cards available, I would be inclined to send people that way so that they don't have to spend money to improve their credit. There are all sorts of free ways to do that. And I would, read through bankrate.com for more strategies on how to do that. The other great resource is Credit Karma. You have to make an account, but you don't have to buy anything and put a credit card, as part of your registration. You can look through, they've got a lot of really great advice about how to improve your credit report and how to improve your credit score. So it's another great place. And I think they've got a little widget, like a calculator. If I made this move, how would it change my score? So you can figure out what would be the most impactful thing to do, which is really helpful if you're just trying to learn. Another question, public service. Okay, eligibility for public service, adjunct faculty at city state entities who do not have consecutive semesters each year. Are you able to file retroactively? Okay, there's two separate questions. The one requirement, if you are adjunct faculty, if you're paid as a W-2 employee, and while you are teaching are considered full-time, meaning more than 20 hours a week, you should be eligible. And they will tell you when you go to either benefits or payroll to fill out the form, whether they deem you eligible. Second part of the question, are you able to file retroactively if you just discovered this forgiveness program? I've heard of some people being credited with some months. So for example, you've been in a income-based repayment plan, you happen to land at Fed loan servicing, you formally apply and are accepted. And because it can take some months for them to get the whole thing set up, they go back and they give you credit for a few months even before you actually applied. I don't think that they will go back for years. I've never seen that. And I have some questions presently about this period during which people have no obligation to pay. And this goes back for a long time now. Remember, they stopped payments back in April of last year. Could you get a free year out of this if you applied now? You might be. I haven't seen that addressed yet on any of the blogs that I'm following on this topic. If you have an unpaid internship or training as part of your associate's, bachelor's, or certification at Veterans Affairs, city, state hospitals, is it public service forgiveness eligible? You have to have income. So you have to, if you worked at Veterans Affairs or the state hospitals and you did 20 hours a week, is there a minimum threshold? Then you can apply. You would be deemed an employee and eligible, but you've got to be W-2. So unpaid internships won't typically qualify. Paid training might, if that was possible. I was doing some research for a client on various other loan forgiveness programs. The US government has programs. If you are an employee of the federal government, Veterans Affairs, some other branches, they will give you up to $10,000 a year in debt forgiveness. So if you work there for a year, it's sort of in arrears. Once you complete the work, you fill out the forms, and they will give you the money to pay that down. So they have a limit on how many years worth of $10,000 you can get, but I thought that was a pretty generous program. Okay. Any other questions?
Question. In terms of like balance transfers and stuff like that, you know, we get a lot of mail and emails about qualifying, and then you try to do it to get everything on one bill to manage your debt. Why do they send you the stuff if they reject you anyway?
Well, because they're using kind of superficial information about you from the credit rating agencies. They're looking for people who use cards and carry balances, but they don't know everything about you until you apply. Because when you apply, that gives them permission to look at your full credit report and get a sense of your income. And they can be sensitive to how much debt, to how much income you have. And I see a lot of people where, you know, they want to apply for $5,000 and they get approved for $2,000, which is really frustrating because it doesn't do as much. So that's what happens, is that they do effectively underwriting, and they look at the bigger picture and decide no, which is annoying. One of the things that's helpful on Bankrate is they tell you what your credit score needs to be successful applying for the loan. They try to give you that information. Who is this card targeted to? They don't get into how much income you need, but at least you know from a credit score standpoint whether you got a shot. So, and they have cards for super high credit, medium credit, and even low credit, which is, you know, if you have a low credit score, that can be a very good, helpful tool to find a place where you can get a card and start rebuilding your profile.
And do these inquiries have a hard effect on your credit score? I know that sometimes when you apply for these balance transfers, they consider a hard inquiry and it could drop your credit score drastically. Is that the case?
So the way that works, these inquiries, when you go to the point of application, so clicking on the website, it's supposed to tell you whether it's going to be a hard inquiry. And so in most cases, it's not. When you're calling, they'll tell you, may I check your credit score? When you say yes, that's a hard inquiry. So how does that affect you? It stays on your report for a year. If you have a lot of these, that's a problem. So you want to be selective in how many times you apply. And the reason for that is, to the credit rating agencies, somebody who's calling up and applying for a lot of cards looks like somebody who's got some cash flow problems. And so it starts to weigh on your score. If you only do it now and again, or you do 2 within a short period of time, no big deal. Same advice if you're applying for a mortgage. You want to do all of your inquiries within a relatively short period of time so that it's recognizable. Oh, was shopping. And it does diminish. It's only worth 10% of your score. So it shouldn't be hugely impactful for very long.
Thank you.
You're welcome. All right.
I believe we have another question in the chat.
Great. All right. I will take some of my friends are receiving letters January, February from law firms holding their former credit card debt, offering to settle the debt at 50% if they pay now. Would you recommend it? The first thing I would do is get a free copy of their individual credit reports and look at what's on there. Because here's the thing, if this is really old debt, and credit card debt is governed by consumer protection laws in the state of New York, there's a period at which it's no longer collectible. It is supposed to fall off your credit report 6 years and a day later if you've made no payments. So, for example, a lot of people ended up in big debt around the financial crisis, lost their jobs, couldn't pay their bills, ended up walking away from their credit card debt and never resolved it. That's not even collectible anymore. That's not even allowed to be on their credit reports. It ages off. Student loans, just as an aside, federal student loans never age off. So you're going to see those if you have them. But for credit card debts, first look at the credit report and figure out how old is this debt. If it may or may not be legit to have these offers for settlement. Here's one of the things that happens when people go into debt and are threatened with being taken to court for non-payment. There are companies and reported law firms that are really debt collection agencies, and they take a debtor to court. And if you don't know about this because you haven't been sent any information, no subpoena, whatever, you are deemed in default, and you get what's called a default judgment saying that you owe this debt. And New York has done a lot of work to try to manage this because out-of-state companies were doing this who had no license to do this to New Yorkers. So first, what you want to find out is this genuinely your debt? Do you remember having any cards? Do you remember running up these balances? If it is legit, this may be a good solution if they can afford to do this. But if it's really, really old, like I said, 5-6 years old, it may not be in their interest to do it. So it's sort of a case-by-case situation. I hope that's helpful. I know I kind of went in a lot of directions there. Does your credit score impact your ability to secure a federal student loan? No. You can have like no credit score or a 300 or 350 is actually the lowest score, and you can get a federal student loan. They do not check your credit. More of a question for a person who needs a master's degree to secure a more stable position. So yes, you can apply for a Grad Plus loan. I was just doing research for a client on Grad Plus loans. The great news about them is they let you borrow as much as the cost of attendance for your program. So the cost of attendance, if you look on a school's website, is not just tuition, room and board, fees. It's also the housing element and living expenses. And for people in graduate school, it's typically an apartment, et cetera. So it's like you're able to borrow as much as $30,000 a year. Whether that makes sense or not, do think about whether your intended career will pay you enough to pay that off in a reasonable amount of time, or whether you can enter the public service loan forgiveness program and have it dealt with that way. So hope that's helpful. Great. I'm glad it was. Any other questions?
If not, I have one last question about the loan forgiveness program.
Sure.
When you start the process and you go and you fill out the paperwork, is it possible for the paperwork never to reach that next phase?
Well, here's where I have had people have problems. They drop it off to either HR or the payroll department, and it goes into the paper shuffle in the offices, and nobody knows where it is because it's literally a paper form. There's no electronic version. So you do have to kind of have a relationship with the person who's going to kind of get it signed and send it in for you. Once it's in, you get either a yes or a no. If you get a no, if they reject you, they don't tell you clearly why. And there are two reasons that you can get rejected. One, your employer doesn't qualify. And most people know before they get the form signed that their employer qualifies. And one of the easy ways I tell people to check that is Google the company that is on your paycheck with 501c3 directly after that name. And if it is a 501c entity, you will find information on the website about, their foundation, how to make a tax deductible contribution, etc. So that is easy. Where people get blown out and don't understand what's happened is they have maybe one little loan that is not acceptable or accepted into the public service loan forgiveness program. They don't bother to tell you, hey, go consolidate that one little loan and reapply. So people get the rejection and think, oh, I can't do it. I'm done. And I'm so frustrated. That's why I tell people at the same time that they send the form to get that signed and mailed in, check your loans to make sure that you don't have one of these little quirky ones that's too old or not out of the right program. So you can fix it before they get the application and run that check on you.
Okay. Thank you very much.
You're very welcome. Okay. All right. Well, great questions tonight from everybody. I appreciate it. And I'm looking forward to our final session. Hope you'll all plan to attend. Bring a friend. So we're going to talk about how to manage your money in emergencies. Mm-hmm.
Yes. So thank you everyone for joining. Our final session will be next week, Thursday at 6 o'clock. And we look forward to seeing you all then.
Perfect. Thank you.
Thank you, everyone.